Hi guys, welcome. This is Jyoti Prakash Anandan, and in this episode, you will be seeing how to strategically catch the lows of the market. So, the objective is pretty clear. You just have to find the optimal spot at which you have to catch the market in order to increase your returns. So, what are all the things you need? First, you need the strategy that I will be giving you right now. Second, you need money. That is one thing you have to earn it from your end. Third one is patience. That one you have to grow it from your end. So let's jump right in. Okay. So in order to do the analysis, you are just going to get the Nifty weekly historical data, Yahoo. So Yahoo Finance is like a free website. You can get a lot of stocks as historical data over here. I'm taking Nifty over here as I consider that as the market. So I'm just setting the frequency to weekly over here because daily means if you are a day trader, you can pick that. If you are an SIP investor, you can pick monthly, but we are somewhere in between who is active and passive at the same time, and we will be looking for optimal spot to catch the lows of the market. So let's just set the time frame to max, and we will be having 15 years of data over here. Just click on apply, and the data is loaded. Now we just have to download the data. Let's just open the file, and we are seeing that the data is in CSV format. I don't want that. I actually want this in a Excel format. So let's just change the file to Excel, save, and yes. So let's just calculate the percentage. I mean, we have the OHLC data over here. So week wise, what is the open, low, high, and close data over here? We are trying to catch the lows of the market. So percentage low. Let's find the lowest point of that particular week. Okay. So let's find a low minus open divided by open, and let's put 100. It's just to get the percentage, and yeah, so you will be seeing 0 over here because we are not taking any kind of positive value here, because obviously low is going to be less than open, and if it is actually not, it is going to be in 0. So whatever the values which you will be seeing over here will be in negative or in 0. Okay. So let's round off the value over here because I want to uh, cluster the data in order to find the optimal uh, information and threshold so that I can invest. So let's round off the values over here. Yes. So yeah, we have rounded off the value, and I'm adding two more columns here just to get some more insights from the data. Year and month. This is just fairly straightforward. I'm just extracting the year uh, to actually club the data to see it a bit more visually attractive. Yes. Now let's do the same for over here. Extract the month, put it as number. Yes. Let's just save the data, and let's start the analysis. Let's see what. Let's insert a pivot data over here. And once the pivot table is here, let us extract low round. Yes. Now you can see that in the, yeah, in the past, how many times the market went down. It's in sum. Let's just change it to count. Yes. 753 weeks. And out of the 753 weeks, how many times the market went down uh, by 0 or less than 0? That's on that means on the negative territory. So let's just say that I'm setting a threshold over here, just with the hint, just like I'm just setting it as 5% or less. So I'll just remove it over here. Yes. So we had 753 weeks we just saw in the pivot table. So out of the 753 weeks, we can see that 76 weeks the index actually went down by 5% or less. So these are all the opportunities which we are looking for. 5% of the times the market went down, 5% or less the market went down like 24 times. 6% it's 21 times. So these are all like the investment opportunities which I am talking about. So let's say you are investing over here when the market is down by 6% in that particular week, and you catch that low by investing maybe let's say 10,000 rupees or so. Once the market is going to come up, this 6% is going to be your revenue. So this is going to be the 6% which is like the extra returns you're going to get. uh, the reason why I created year and month here is that if we are interested in seeing the data flow, in the sense throughout the years, how the data, how the index actually fell down on which month, how much percentage. So if we want to see that kind of information, we can see it, yes, over here. So 2007, 10th month, 11th month, and 12th month has negative values, and we can see the percentage of it went down, the number of times it went down, and 2008 is the subprime mortgage crisis year. So we can see that this is like a lot. So about, yeah, 25 times the market actually went down in that year with these many percentage of down movements. So yeah, the extreme case 22 percentage in a particular week. So that's like pretty intense. Um, so I think you might be having some fair idea over here. So 753 weeks in the past 15 years, and we can see that 76 weeks the market went down by less than 5 percentage or more. So that's like 10 percentage of the times. So each and every once in 10 weeks, we will be having an opportunity to catch the market at its lowest. So 10 percentage of the times. So that's like once in 10 weeks. So this is where the time interval is coming into play. And let me show you the analysis I have already done. So this is just the value which you saw from the pivot table. So let's set a threshold over here. Okay. So 5 to 10 percentage, I'm setting up a threshold because it's happening a lot of times, nearly obviously. So 70 out of the 76 occurrences of negative visit to the territory, it is 65 times over here. So 5 to 10 percentage of 5 to 10 percentage of the movement, it can happen anytime in like once in every 10 weeks. So we should be ready to invest our money. And 10 percentage or greater, it is happening very rarely. So in the past 15 years, it's like happened only 11 times. So that's what I have given over here as an observation. So uh, it's like 1.4 per 46 percentage of the times of occurrence when the market is going down below 10 percentage. So that's like pretty rare. You have to invest a lot, and in order to catch the lows. And over here, 5 percentage to 10 percentage, it's like nearly uh, and occur nearly like once in 10 weeks it will most probably happen. So you have to be very cautious in order to get the most out of the uh, result. So let's go to the recent years. Actually, that's one interesting thing. Okay, yeah. In 2022, so far we haven't seen uh, a big drop in the index. So in 2021, we can see multiple occurrences over here. It has happened three times. 2020, it fell down a lot. I think you might remember because in 2020, the index went from nearly 13,000 points to 7,500 points. So that's like one of the biggest shocks and movements. So if you would have followed this strategy, the strategy over here is that if the market goes below 5%, I will invest. If the market goes below 10%, I will invest a lot. So that's what you have to keep in mind. 5%, you have to invest immediately. 10% or more, quickly invest because the market will obviously rise up in the coming years. But you have to have the patience and the money to actually achieve this. Now you have the strategy from me. Now the second and third part is the one you need. Once you have the money and the patience, with this strategy you can obviously earn a lot. Good luck. So thank you.